On the 15th of March, 2023, at exactly 9:01 a.m. Zurich time, the Saudi National Bank chairman made a remark that lasted 12 seconds. A Bloomberg reporter asked a simple question: would his bank increase its stake in Credit Suisse? Ammar al-Qudari leaned toward the microphone and said, absolutely not. For many reasons outside the simplest reason, which is regulatory. 12 seconds. By market close, Credit Suisse stock had crashed 24% to a record low of 1.55 Swiss francs. 5-year credit default swaps, the cost of insuring against default, exploded past 1,000 basis points. This was a level that had signaled the death of Lehman Brothers in 2008. In Zurich, depositors were pulling 10 billion Swiss francs every single day. The Swiss National Bank was forced to inject 50 billion francs in emergency liquidity just to keep the lights on. 4 days later, on the 19th of March, the Swiss government gathered the leaders of UBS and Credit Suisse. The message was unambiguous. UBS would acquire its 166-year-old rival for 3 billion Swiss francs, or the authorities would let Credit Suisse file for bankruptcy and nationalize the wreckage. The final price was half the value of Credit Suisse's Zurich headquarters building, a bank that once managed $1.6 trillion in assets, that had financed the Swiss railway system. A bank that had survived 2 world wars and the Great Depression was sold for pocket change. But this was no accident of timing. The Saudi chairman had not destroyed Credit Suisse. He had merely named what everyone already knew. Credit Suisse was a bank that had spent 15 years systematically destroying itself. The story of how it did so is not about spreadsheets or balance sheets or capital ratios. It is about human beings and the things that happen inside an institution when nobody is watching. When winning becomes the only thing that matters, and when the people paid to stop disaster become the ones accelerating it. To understand how Credit Suisse died, you must first understand what it believed itself to be. The bank was founded in 1856 by Alfred Escher, a Swiss politician and industrial magnate. He looked at a nation of mountains and valleys and saw a financial empire. Switzerland had no railroads, no heavy industry, and no way to move goods between Europe. Escher's vision was simple and audacious: build the railways, finance the railways, and control the railways. Credit Suisse was born as a project bank, a machine for turning Swiss ambition into iron and steel. Within 20 years, Switzerland had a rail network that connected every major city. By 1900, Credit Suisse was the largest bank in the country. The formula was simple: conservative Swiss banking married to long-term industrial vision. Deposits came from Swiss citizens who trusted the bank implicitly. Loans went to projects that built the nation. Risk was managed, not chased. This identity calcified over the 20th century into something almost sacred. Credit Suisse was not merely a bank. It was a symbol of Swiss competence, discretion, and permanence. When American banks collapsed during the Great Depression, Credit Suisse stood. When European banks were nationalized after World War II, Credit Suisse stood. The bank's headquarters on Paradeplatz in Zurich became a monument to stability. This belief that Credit Suisse was fundamentally different became its fatal inheritance. Because when an institution believes it cannot fail, it loses the ability to see its own rot. The transformation began in the 80s and accelerated through the 90s. Swiss banking secrecy was under international pressure. The old model was being challenged by American banks that were bigger, faster, and more aggressive. Credit Suisse looked at the fortunes being made in New York and London. They decided that being Switzerland's bank was no longer enough. In 1988, Credit Suisse acquired a controlling stake in First Boston. The acquisition was meant to catapult the bank into the top tier of global finance. Instead, it imported a culture built on leverage, trading risk, and the pursuit of bonuses. The merger created 2 Credit Suisses: the conservative Zurich Bank and the aggressive investment operation. For over a decade, these 2 cultures coexisted in an uneasy tension. The Swiss side generated stable fees, but the investment bank generated explosive profits and risks. By 2006, the investment bank tail was wagging the Swiss dog. Bonuses in New York and London dwarfed anything paid in Zurich, and the traders were stars. When the 2008 financial crisis hit, Credit Suisse survived, but only barely. It was smaller than U.S., which absorbed a $60 billion government bailout. Credit Suisse raised capital from outside investors, including Qatar, and presented itself as prudent. They claimed they weathered the storm through discipline, but the narrative was seductive. The reality was different. The post-negative 2008 years should have been a period of reflection. Instead, they became a period of escalation. The bank's leadership concluded that the near-death experience had proven their resilience. The lesson they drew was not that they had taken too much risk. The lesson they drew was that they had survived because they were special. This was the foundational delusion, and from it, everything else would flow. The first public crack appeared in 2014, and it was massive. On May 19, 2014, Credit Suisse pleaded guilty to criminal charges in a federal court. The charge was conspiring to aid U.S. taxpayers in filing false income tax returns. For decades, bankers helped thousands of wealthy Americans hide billions from the IRS. They used Swiss bank secrecy laws as a shield and destroyed records. They even traveled to the United States to meet clients in secret locations. They never carried business cards or left paper trails. The bank paid $2.6 billion in penalties. It was the largest penalty ever imposed on a Swiss bank in a U.S. case. 7 Credit Suisse employees were indicted for their roles. The Department of Justice described a culture of institutionalized concealment. In Zurich, the bank's leadership treated the guilty plea as a one-time cost of business. They paid the fine, issued a statement about compliance, and moved on. There was no fundamental reckoning with what allowed this behavior to flourish. The guilty plea should have been a mirror. Instead, it became a receipt. It was proof that Credit Suisse could absorb criminal convictions and continue operating. This emboldened everyone inside the bank who had learned the wrong lessons. What followed was a cascade of scandals, each more damaging than the last. Each revealed a culture that had completely lost its ability to self-correct. In 2018, the Mozambique tuna bonds scandal detonated. Between 2013 and 2014, Credit Suisse bankers arranged $2 billion in loans. These were for Mozambique, one of the poorest countries on Earth. The loans were supposedly for a tuna fishing fleet and maritime security. In reality, the loans were a vehicle for massive corruption. At least $200 million in bribes were paid to officials and bankers. The country was plunged into a debt crisis that collapsed its currency. It pushed 2 million people into poverty. When the International Monetary Fund discovered the hidden loans, Mozambique defaulted. The scandal resulted in Credit Suisse paying $475 million in penalties. 3 Credit Suisse bankers pleaded guilty to criminal charges. One of them admitted to receiving $45 million in kickbacks. Personally, the tuna bonds were not a rogue operation. They were approved formally. Multiple levels of management signed off on loans to a failing industry. Internal controls that were supposed to catch this had failed completely. In 2019, another scandal erupted from inside the executive suite. The bank hired private investigators to conduct surveillance on former employees. The target was a star executive who had joined a rival bank. He was followed through the streets of Zurich by hired detectives. When confronted by the target on a street, the operative tried to flee. The resulting confrontation was witnessed by passers-by, and the operative was arrested. The investigation revealed that the surveillance was ordered at the highest levels. The CEO at the time denied any knowledge of the operation, but an internal investigation found the chief operating officer ordered it. The officer resigned, and the CEO was eventually forced out of the bank. The Spygate scandal, as it became known, was honestly surreal. A 166-year-old bank had been reduced to a cheap detective agency. The absurdity masked paranoia, toxic politics, and a completely dysfunctional culture. Spying on their own people seemed like a reasonable course of action. Then came 2021. In the space of a single month, Credit Suisse revealed its risk management had failed, and it had ceased to exist as a meaningful function. In March 2021, Greensill Capital collapsed. Greensill was a supply chain finance firm founded by Lex Greensill, a charismatic Australian who convinced the world's largest institutions he had reinvented finance. Credit Suisse partnered with Greensill to package loans into investment funds, which the bank sold to clients as safe, short-term, low-risk investments. The funds held $10 billion in assets. Credit Suisse marketed them as nearly equivalent to cash, conservative investments for conservative clients. But the underlying loans were anything but conservative. Greensill had extended billions to companies that were effectively insolvent, including Sanjeev Gupta's GFG Alliance, which had been losing money for years. The lending was unsecured, the due diligence was absent, and the risk was catastrophic. When Greensill's credit insurance was not renewed in March 2021, the entire structure collapsed. Credit Suisse was forced to freeze $10 billion of client funds. The clients, wealthy individuals and pension funds, had been told these were safe investments. Instead, they discovered their money had been funneled into opaque loans to struggling companies through a lender the bank failed to investigate. The reputational damage was immense, but it was about to get worse. 3 weeks after the Greensill funds were frozen, Bill Huang's family office, Archegos Capital Management, imploded. Huang, a former trader, had built enormous concentrated positions in media and technology stocks, using total return swaps. These derivatives allowed him to bypass disclosure requirements and leverage his positions to extraordinary levels. By March 2021, Archegos had amassed exposure exceeding $100 billion, with actual capital of roughly $10 billion. Multiple banks were providing prime brokerage services to Archegos, including Goldman Sachs, Morgan Stanley, Nomura, and Credit Suisse. When Viacomcp's stock began falling in late March 2021, the entire structure began to unravel. Goldman Sachs and Morgan Stanley moved quickly, exiting their positions and limiting their losses. Morgan Stanley lost $911 million, and Goldman Sachs emerged essentially unscathed. Credit Suisse, by contrast, lost $5.5 billion. That number deserves to be stated plainly. $5.5 billion in a single counterparty blowup in a prime brokerage business. The reason was not market conditions or bad luck. The reason was that Credit Suisse had extended Archegos far more leverage, on far worse terms, with far less collateral than any other bank. While Goldman Sachs was demanding daily margin calls and appropriate collateral, Credit Suisse was essentially writing blank checks. The bank's prime brokerage risk team had flagged growing concerns about Archegos internally. Those concerns were ignored. The traders generating the revenue were too important. The relationship was too profitable until it wasn't. The Archegos loss alone was larger than Credit Suisse's entire net income for 2020. Combined with the Greensill disaster, the bank had vaporized over $15 billion of value in a single month through failures that were entirely foreseeable and entirely preventable. The pattern was unmistakable. Every internal control system had been overridden by the same force. The desire to win the next deal, book the next trade, collect the next bonus. Risk managers, who raised concerns, were marginalized or overruled. Revenue generators, who took enormous risks, were rewarded with enormous pay. The people who were supposed to say no had learned that saying yes was better for their careers. This is not a story about complex financial instruments or sophisticated fraud. It is a story about human nature. Inside Credit Suisse, the incentives had become so distorted that good people made terrible decisions. Not because they were evil, but because the system they operated in had been designed to reward recklessness and punish caution. In February 2022, a massive leak of Credit Suisse client data, known as the Suisse Secrets, revealed that the bank had maintained accounts for clients involved in torture, drug trafficking, money laundering, and corruption. The investigation, published by a consortium of 48 media organizations, analyzed data on more than 18,000 Credit Suisse accounts. It showed that the bank had done business with a Yemeni spy chief implicated in torture, a Jordanian accused of corruption, the sons of an Egyptian dictator, and a Venezuelan official convicted in $1 billion graft scheme. The accounts held more than $100 billion. Credit Suisse's official response was that 90% of the accounts in question had already been closed. The implication was clear. The bank's client vetting procedures had been so porous for so long. That cleaning up the mess required closing the vast majority of accounts flagged in the leak. By the end of 2022, the institution was hemorrhaging. Client withdrawals reached 110 billion Swiss francs in the fourth quarter. It was the largest quarterly outflow in the bank's history. Revenue collapsed, and the share price plummeted below 3 francs. Employees began leaving in droves, while counterparties demanded more collateral. The death spiral was accelerating. The final act played out across 5 days in March 2023. Credit Suisse was not a small bank. It was a global titan, one of 30 institutions deemed so large its failure would threaten everything. It operated in 50 countries and employed over 50,000 people. Its collapse would not be a failure. It would be an earthquake. The trigger was the collapse of Silicon Valley Bank in March 2023. The failure sent a shockwave, and investors began scanning for the next target. Credit Suisse, weakened by years of scandals, was an obvious choice. On the 9th of March, the auditor identified material weaknesses in internal controls. The announcement was devastating. If the auditor did not trust the numbers, who would? The Saudi National Bank chairman's comment landed on this tinder. The market reaction was immediate, brutal, and frankly existential. Wealth management clients were pulling money out at rates that would empty the bank. The Swiss National Bank's 50 billion franc liquidity line failed to stabilize things. The market had lost faith not in the balance sheet, but in its future. When clients believe a bank might fail, their withdrawals ensure that it will. On Friday, the government and regulators began a forced marriage negotiation. The only viable buyer was UBS, their larger and more conservative rival. Over 48 hours, a deal was hammered together that was once unthinkable. The terms were brutal. UBS would pay 3 billion Swiss francs, roughly $3.25 billion, for the entire bank. This was a 60% discount to Credit Suisse's market value. UBS demanded, and received, a government guarantee covering 9 billion francs. The Swiss National Bank provided 100 billion francs in liquidity support. FINMA ordered the complete write-down of 16 billion francs in bonds, a controversial decision that upended the standard hierarchy of creditor claims. It triggered lawsuits that will likely continue for years. Credit Suisse shareholders received 1 UBS share for every 22.48 shares. The largest shareholder, Saudi National Bank, was wiped out. Their stake, purchased just months earlier, was essentially worthless. The 12-second comment that triggered the panic cost them over $1 billion. On the 19th of March, 2023, the Swiss president announced the deal. CEO Ulrich Korner called it a historic, sad, and challenging day. UBS chairman Colm Kelleher expressed no sentimentality. It is an emergency rescue, he said. And just like that, a 166-year-old institution was gone. What does the death of Credit Suisse teach us? The first lesson is about culture. Every bank has policies, compliance departments, and audit committees. These structures exist on paper at every financial institution, but they are only as strong as the human beings who enforce them. In an environment where revenue trumps everything else, people get corrupted. At Credit Suisse, the culture of winning overwhelmed the culture of prudence. This did not happen overnight. It happened gradually, decision by decision, bonus pool by bonus pool, ignored warning by warning. Each time a risky trade paid off, the risk taker was rewarded. Each time a compliance officer raised a concern, they were sidelined. Over decades, this dynamic selected for people willing to take risks, and it worked against the people who were willing to stop them. The second lesson is about accountability. Credit Suisse's collapse was not the result of a single catastrophic decision. It was the cumulative result of thousands of decisions made over many years. These were decisions that were individually rational, but collectively catastrophic. The risk taker who booked another trade, the wealth manager selling toxic funds, the officer signing off on bad loans. Each of these people operated in a system that told them their behavior was desirable, and each of them contributed to bringing down a 166-year-old institution. The third lesson is about memory. Financial institutions have an extraordinary capacity for forgetting. After every crisis, there are internal reviews and solemn promises that things will be different. Then, as time passes and memories fade, the old behaviors return. Credit Suisse forgot the lessons of 2008 and its own criminal history. It forgot, again and again, that risk is real. The final lesson is perhaps the simplest and the hardest. Institutions are not protected by their history, their reputation, or their size. They are protected only by the daily decisions of the people within them. A 166-year-old bank can die in a weekend if the culture is hollowed out. Credit Suisse was not brought down by short sellers or market panics. It was brought down by its own people. The collapse was not a tragedy, because tragedies happen to the innocent. This was a suicide, committed slowly over decades. The firm kept taking risks. It did not understand, trusting people who did not deserve it, and it believed, to the very end, that it was too important to fail. In the final board meeting before the deal, a director asked if there was an alternative. The answer was silence. There was no alternative because, by that point, there was nothing left to save. The 166-year-old institution had already been dead for years. The market just hadn't noticed yet.